In this video, we are going to show you how you can trade the new week or new day open gap as this, and this is based on the idea that whenever there's a new day or new week open gap, whenever there's a new day or new week open gap, price tends to form a short-term market structure away from it and then back to the 50% of that gap before it makes a decision to trade away from it. Now we have this Euro USD 5-minute time frame. We have this new week open gap at this point. Today is Monday, though the charts are showing Sunday, but today is Monday. You can see from this, it's Monday 5:27 a.m. in East Africa. So first things is we have a gap open. This is a 5 minutes new week open gap, and then you have price forming a downward structure away from this gap. Now price opens here, goes up, and then comes and closes below. Let me just delete this everything, remove all the drawings, start afresh. So we have new week open gap like that. So this new week open gap forms, and then we have price trading lower, giving us a lower market structure, a downward market structure, and this is shown by the fact that we have price closing below this low, right? Then a short-term reversal, and then closing below this low, price closing below that low, and then a short-term reversal, and then now we have these lows here that price failed to close below. Now this is what we call liquidity sweep, because price has failed to close below it. It was just sweeping this accumulated liquidity right here, and then probably make an upward move. And for us to confirm that the market structure has shifted, we have price closing above this lower high with this massive impulsive movement to the upside. So with this move, with this market structure shift, with this impulsive move to the upside, closing above this lower high, we will now have this as our market structure shift. And then with that, this becomes our breaker block. Our breaker block is the last up close candle before a sweep of liquidity, and now we have this happening. So price is retracing into this breaker block and then going up, as you can see here. But how do we engage this market? So the engagement is very simple. You have price closing above, right, and then coming below, forming coming into the breaker, and then closing above it with this move or this very bullish candle here, and price is closing above the breaker block. At the same time, it is closing above this bearish candle right here. See this bearish candle right here? So those are two conditions that are confirming to us that price is now likely to go up. Now, so the idea, as I have said, is price is going to trade to at least 50% of this new week open gap. So we want now to take a trade that takes us there. With that in mind, we have, with this bullish candle closing outside above this breaker block and above the open of this bearish candle, we have these two candles giving us a dealing range. A dealing range simply something that will help us know where we can get an optimum entry. So with that in mind, you see at the 50% of this dealing range, I'll just mark that this is the 50% of that dealing range right there. So with that in mind, we want now price to retrace into the 50% and then go up, right? So, and that is what, and that is now how we execute a trade like that. Stop loss just below this swing low right here, and take profit is at the 50% of this new week open gap. And let's see how much it gave us. It gave us a 5.57 risk to reward ratio. So that is how you could have participated in a trade leading to the 50% of the new week open gap. So I've done this in the 5-minute time frame. You can also do it in the 1-minute time frame if it presents clean market structure like this. This one was a clean market structure, giving you valid entry points, valid breaker block, and yes, something like that. So this is something you can look out for in other pairs or in other assets as well. Till next time, bye bye.